Never fight the trend. The trend is your most powerful ally in forex trading. Most beginner traders lose money simply because they don't understand two things: market structure and lot size. Once you master these two concepts, everything else in trading starts to make sense. Market structure tells you which direction the market is moving and where price is likely to go next. Lot size controls exactly how much money you risk on every single trade. By the end of this video, you will know exactly how to read market structure and calculate your lot size like a professional. Let's get into it. Before we talk about market structure, let's quickly understand what the forex market actually is. Forex is the global marketplace where currencies are bought and sold against each other. Every time you place a trade, you are buying one currency while simultaneously selling another. It is the largest financial market in the world, with over $6 trillion traded every single day. Market structure is the single most important concept you will ever learn as a forex trader. It tells you whether the market is in an uptrend, a downtrend, or moving sideways. Without understanding structure, you are essentially trading blindfolded. Professional traders read market structure before they even consider placing a single trade. Now, even if you read the market perfectly, the wrong lot size can still wipe out your account. Lot size determines the value of every pip, and that directly impacts your profit and your loss. By the end of this video, you will know exactly how to calculate the right lot size for any trade. This is the foundation, so let's build it properly from the ground up. To understand market structure, we first need to learn about swing highs and swing lows. A swing high is a candle that has a higher high than the candles directly to its left and right. Think of a swing high as a peak, the highest point before price turns back down. A swing low is the opposite, a candle lower than both the candles beside it. Think of a swing low as a valley, the lowest point before price bounces back up. These 2 points, the swing high and swing low, are the building blocks of all market structure. An uptrend in forex is defined by one simple pattern: higher highs and higher lows. Each time price makes a new high above the previous one, that is called a higher high. And each time price pulls back but stays above the previous low, that is a higher low. As long as this pattern continues, the market remains in a valid uptrend. Experienced traders only look for buy setups when the market is in a confirmed uptrend. A downtrend is the exact opposite. The market makes lower highs and lower lows. Each swing high comes in lower than the previous one. The market is losing strength. And each swing low comes in below the previous low, confirming the downtrend remains intact. In a downtrend, professional traders look for sell opportunities, not buys. The third type of market structure is a range, where price moves sideways between two levels. The top of the range is called resistance, and bottom is called support. In a range, price tends to bounce from support to resistance repeatedly until it breaks out. Ranging markets can be tricky. Many beginner traders get trapped trading in the middle of a range. One of the most powerful signals in market structure is called a break of structure. A break of structure happens when price closes above a previous swing high in an uptrend. This signals that buyers are in control and the uptrend is likely to continue. A break of structure is often the first confirmation that a new trend has begun. Always wait for a full candle close above or below the level, not just a weak touch. Before placing any trade, you must first identify which of the three market conditions you are in. Uptrend, look to buy. Downtrend, look to sell. Range, wait for the breakout. Never fight the trend. The trend is your most powerful ally in forex trading. Once you identify a break of structure, you wait for price to pull back before entering. This pullback into the broken level gives you a high probability entry zone. When price shows a reaction from that zone, that is your entry signal. Your stop loss always goes below the most recent swing low for a buy trade. Your take profit targets the next major swing high above your entry. These 5 steps make up a complete structure-based trade setup from start to finish. Now that you understand market structure, let's talk about lot sizes. In forex, a lot is simply the unit used to measure the size of a trade. A standard lot equals 100,000 units of the base currency, worth $10 per pip. A mini lot equals 10,000 units, worth $1 per pip.
A micro lot equals 1,000 units, worth 10 cents per pip.
As a beginner, you should always start with micro lots to protect your capital while you learn. The most important risk management rule in trading is the 2% rule. Never risk more than 2% of your total account balance on any single trade. On a $1,000 account, 2% equals $20 at risk per trade. If your stop loss is 20 pips, your pip value needs to be $1, so you trade 0.2 mini lots. Controlling your risk on every single trade is what separates professionals from gamblers. Here is the exact formula you will use to calculate your lot size every time you trade. Lot size equals your risk amount divided by your stop loss in pips multiplied by the pip value. $20 of risk divided by 20 pips times $1 gives you exactly 1 mini lot. Practice this formula on every trade until it becomes second nature. Let's now walk through real chart examples so you can see exactly how this works in practice. This is the Euro USD on the 4-hour time frame, showing a clear bullish market structure. Price approaches this previous swing high, our key level to watch for a break. Price breaks and closes above the swing high, we have a confirmed break of structure. Price then pulls back into the broken level, exactly where we want to buy. A bullish reaction candle forms inside the zone. This is our entry signal. Stop loss is placed below the most recent swing low, keeping our risk defined. Take profit is set at the next swing high, giving us a clean risk to reward ratio. Price moves cleanly in our direction, the trade reaches take profit successfully. Now let's apply our lot size calculation to this exact trade so you can see how it all connects. Account is $1,000, we risk 2% and our stop loss is 25 pips. $20 divided by 25 pips times $1 gives us 0.8 mini lots. We enter 0.8 lots and our maximum loss is capped at exactly $20. Not every trade wins, and it is important you see how a losing trade looks too. This GBP USD H4 chart shows a bearish break of structure to the downside. We identified the setup correctly, entry, stop loss, and take profit all placed properly. Price reversed and hit our stop loss. This trade was a loss. Because we used proper lot sizing, our loss was only $20, not our entire account. Losing trades are part of the game. What matters is that you keep your losses small and your winners larger. Let's quickly look at multiple historical examples to reinforce what we've learned. Example 1, bullish break of structure on the daily, followed by a strong upward move. Example 2, bearish break of structure, followed by a clean sell-off. Example 3, a break of structure that failed, resulting in a controlled loss. Backtesting teaches you to see the strategy clearly before you ever risk real money. Spend at least 10 hours backtesting any strategy before you risk a single dollar of real capital. Let's quickly recap everything we covered in this video. Market structure tells you the direction the market is moving, uptrend, downtrend, or range. Uptrends form with higher highs and higher lows, always trade in that direction. The break of structure confirms the start of a new directional move. Wait for the candle close. Always confirm the break with a full candle close, not just a wick through the level. Lot size controls your risk on every trade and must be calculated before each entry. Use the formula, risk amount divided by stop loss pips times pip value every single time. The 2% rule protects your account from large drawdowns. Respect it always. Before I let you go, here are my top 5 tips specifically for beginner traders. Tip 1. Always identify the market structure before you even look for an entry. Tip 2. Never trade against the trend, no matter how strong the signal looks. Tip 3. Start trading on a demo account with micro lots until your strategy is consistently profitable. Tip 4. Calculate your lot size before every single trade, no exceptions. Tip 5. Patience is your greatest edge in Forex. Only take the setups that meet all your criteria. Trading is a journey, not a get-rich-quick scheme, and every professional started exactly where you are now. Master the fundamentals first, and the profits will follow naturally over time. You now have the knowledge. The next step is to go out there and practice what you've learned. If this video helped you, smash the like button. It genuinely helps more traders find this content. Subscribe to the channel so you never miss a future trading tutorial. Drop your questions in the comments below. I read every single one, and I will see you in the next video.